You've heard the expressions, buy the dip, hodl, YOLO, diamond hands, Wall Street bets. Some are saying to invest now while others are saying to sell. So who do you listen to and what do you do? Do you try and time the market? There's so much fear right now about interest rates, inflation, government debt ceilings, and a recession around the corner. This must be the time to sell, right? And especially right now with all this fear and negativity, you're going to hear a lot that it's time to sell, that the market is just going to keep on going lower. But what can we learn about market timing? Well, let's take Warren Buffett, for example. If there's anyone we can learn about the market from, it's gotta be him. So in an old interview, he was asked, how does he time the market so well? And he answered that he actually has no idea what the market is gonna do. And in fact, he doesn't try and time the market based on what's happening in the economy, in the stock market, or even around the world. And he actually goes on to say that timing the market, instead of doing that, you're better off having a monkey throw a dart at a wall and trying to see which stocks he ends up hitting. Okay, so Warren Buffett was of no help. What now? Well, let's take a look at what history has to say. And there's a story about 3 investors who, over the span of 40 years, invested $200 per month and put it into the S&P 500. So over that 40 years, they've invested $96,000 in total. But the timing of their investment changes. So our first investor, let's call him Bill, actually won the record for having the worst possible timing ever. He invested at the top of every market cycle right before the big crash. So that includes Black Friday, the Kuwait War, the dot-com crash, the Great Financial Crisis, and the COVID crash. He would save up in his account every month that $200, making 3% interest in his savings account. And as soon as the market reached the top, he would put that money in right before it crashed. And so at the end of 40 years, Bill, he never sold any of his stocks. He reinvested all of his dividends. And at the end, he was left with $765,000. Not bad for someone with bad luck, right? All right, now let's take a look at our second investor. And so our second investor is Sarah, and she actually had a crystal ball. So she knew exactly when the market was going to crash and invested right at the bottom of those crashes. Her timing was impeccable. So she would save up, very similar to Bill, she would save up in her checking account or savings account and would make 3% on that money. And as soon as the market crashed and it hit the bottom, right before it was about to go back up, that's when she invested it all. And she blew it out of the park. At the end of 40 years, she had $1.1 million in her account. It really can't get any better than that, can it? All right, so that's where our third investor comes in. Let's call her Stacy. She didn't care about what was happening in the market, what was happening in the news. She didn't care what the price point was. All she did was receive the $200 from her paycheck and deposit it straight into her bank, into her investment account. In fact, she had it fully automated. So as soon as her paycheck came in, that was the first withdrawal and it was automatically invested. She actually didn't even open up her investment account. And guess what? At the end of 40 years, her account had grown to almost $1.4 million. Now, why is that? Why did her account, who only put in money every month, didn't wait and time the market, why did hers do well? Well, it's a concept called dollar cost averaging. Let's take another example because I think this will really help explain what's so great about dollar cost averaging. The early 2000s were often considered the lost decade because during that time, the market was essentially flat. It went up and down, but at the end, it basically stayed at the same level. If you invested on January 1st, 2000, since then the market went down and you wouldn't have made your money back until August of 2007, right before the Great Financial Crisis. And then the market crashed again and you wouldn't have recovered until December 2012. So over a period of 12 years, if you bought at the beginning and waited till for 12 years later, you likely could have ended up with marginal returns, like a few percentage points. But if you were buying consistently, even when the market was down, you would have done really well. So think about it this way. You're buying on the way down, every paycheck you're investing that in, and then on the way up, you're investing it as well. And over the long run, your average price becomes really low. And the reason that you do really well during times like that is because you're essentially buying stocks when they're on sale. And so when you're buying on sale, you can buy more shares for the same amount of money. Your dollar goes a lot further. So in this example, if you had bought at the beginning of 2000, by the end of 2012, your account would be up only 5%. But if you were buying consistently over those 12 years and reinvesting your dividends, you would have been up almost 40%. That's 8 times more versus if you weren't buying consistently. All right, so when you're looking at your returns, there's 2 aspects that really impact investment returns. And the nice thing is dollar cost averaging actually helps to minimize those things. So the first one is taxes. Every time you sell a stock, especially if it's in a regular personal account and not like a TFSA, for example, you have to pay taxes on that. And the biggest implication of this is not only do you get rid of your shares, but you're now paying taxes on those gains. So you have to sell even more to pay for those taxes. And so at the end, you're left with a smaller amount in your account that can grow exponentially and compound further. And the second one is fees. Every time you buy and sell a share, you pay commission. And this amount can vary by brokerage. Some brokerages are $0, but then they get you in other ways. And then some brokerages actually can go up to like $10 or $20 per trade. And especially when you're paying that much in fees, that can really add up and really impact your returns in the long run. Okay, so not only do you have fees related to buying and selling, then you have fees related to if you have someone managing your money for you. For example, let's say you put your money into a mutual fund that's actively managed, or if someone's managing the money for you, you might be paying 1 or 2% for that money to be managed. Now, it might not seem like a lot, but 1 or 2% can add up to hundreds of thousands, if not millions, over the long run. Let's look at another example where someone invested money into the market and then what those returns would have been if they were actively managed. Okay, so you've got someone that's investing, let's say $1,000 a month over 40 years. And during that average 40-year period, the stock market returned 9.7%. So the money that you've been investing at the end of those 40 years would be worth $5.8 million. Not bad, right? Now let's say you had someone manage that money for you, so maybe an advisor, and they charged you 1%. Well, it's only 1%, it's a small amount, it won't have a big impact, right? Well, actually now instead of 5.8 million, you're down to 4.3 million. Now let's say that money is invested in a mutual fund, and so you've got 4.3 million, but they're also charging you 1% fee within the mutual fund. So now instead of 4.3, now you're actually down to 3.2 million. So where you could have invested your money into an ETF that follows the S&P 500, like the SPY or ones from Vanguard, and some of these ETFs actually charge very little, some as low as 0.1%, and some are even lower. You're instead now paying advisors and mutual funds to actively manage your money, and you're throwing away huge sums of your net worth. And that's one of the advantages of investing in an ETF. They're designed so that they mirror the index at the S&P 500, but whenever they're buying or selling within that index, it's not impacting your returns because they're very tax efficient. The only time you would pay taxes on them is if you sell them. So let's say you buy the SPY ETF for $100, it goes up to $150. You would pay taxes on the $50, not the actual trades that happen within that ETF. Okay, so we went through a lot, the benefits of dollar cost averaging, why you need to just tune out all the noise and invest for the long run. After a few years of my own trading and investing, I realized that taxes and fees actually do eat up into your returns quite significantly. And also if you take into account the time, for example, if you're day trading, you're watching webinars of what's happening in the market, you're reading the news, you're following stocks. That can take up a lot of time. And so it might not make sense to put all that time in to get a little bit extra return. And that's one thing that I've decided. Instead of spending more time on actively managing and trading, I can use that time instead to focus on real estate or creating more content like this. And those are some of the reasons that I'm focusing more on index ETFs. I think for where I am right now, it just makes more sense. I hope you found this video helpful in navigating the market, especially during the times that we're in. And don't let the fear get to you. Focus on consistently buying and taking advantage of dollar cost averaging. In the long run, your net worth will benefit a lot. And if you haven't yet liked the video or subscribed to the channel, please do so. It really helps push this content out to more people who could use this. So in the meantime, check out some of my other videos here. Otherwise, I'll see you next week.